Last week, we started cost volume profit analysis. We talked about the introduction to CVP, right? We discussed contribution margin and contribution margin ratio. We talked about margin of safety. We dissected the objectives of CVP, including the formulas that you can use to estimate break-even points. All right, then we had illustrations. We did about 3 calculations last week. Today we are going to have 2 more. And like I said, once we are done with the 2 outstanding illustrations, that will be the end of CVP. All right, so after CVP, we are moving to risk and uncertainty. We have 2 more topics to go. Risk and uncertainty, and then learning curve theory. Okay, so let's see how today's class yes, each question. Let's solve this last illustration. And this was the last illustration test, last question tested by ICAN on the CVP, I think. All right, so let's have this illustration number 7. All right, so let me read. Please, like I said, inform your colleague from the group to join the class. Okay. Abayomi PLC produces and sells 2 major products, A and B. The budgeted income statement for the year to December 31, 2022 is given below. The budgeted selling prices of the products are A, 120 naira, B, 180 naira. Only you are required to determine the break-even sales in unit for each of the products using the budgeted data. Now assume that the following changes are made to the budget. 1. Unit selling price of product B is reduced to 160 naira. Direct material cost is expected to drop by 10% for product A and 20% for product B. 3. Direct labor cost for each product will increase by 10%. 4. Additional 456,000 naira will be spent on advertising. 5. 80% of the total revenue will be derived from product B. Okay? Then requirement B, calculate how much sales revenue must be made to earn an after-tax rate of return of 12% of the revenue. Assume tax rates of 40%. C, assuming all the facts in B1 to 5 above, with the original budgeted revenue of 33,600,000 naira. Compute the revised break-even sales in unit for each of the products. So that is the question. Number A, requirements. We are to determine the break-even sales in unit for each product. All right. How do you do this? When you look at Abayomi PLC, the company produces 2 products, A and B. That means Abayomi PLC is a multi-product organization. Therefore, and examiner is asking you to calculate the break-even points in units. So in this case, that means you need to carry out the 5 procedures, the 5 underlying procedures I provided you last week. The first step is to calculate the overall contribution margin ratio. Then step 2, you calculate overall break-even points in naira. Okay. Then step 3, you calculate sales mix for each product. You determine sales mix for each product. Step 4, you calculate break-even points in naira for each product. Then step 5, you estimate break-even points in units. That's all you need to do. It's as straightforward as that. Okay? So I will stop sharing this and move to the working notes. Let's see how we are going to solve it. Okay. Solution. So illustration 7. That is page, let me check. Page 55. The name of the company is Abayomi PLC. So examiner is asking us to determine break-even points in units. We cannot estimate, we can't just go straight to estimate break-even points in units for a multi-product organization. You have to follow that procedure. Therefore, I will come here, calculating break-even points in units. So how do we do this? We have 5 procedures. Step 1, we need to calculate overall contribution margin ratio. I would then say contribution margin ratio is equal to contribution for the company as a whole, the total contribution for the organization divided by total sales, okay, total sales of the organization. So this will give us the contribution margin ratio. We then go back to the question. According to the question, we are not given contribution. That means we need to estimate contribution, right? Because in this question, we are given sales value. We also have direct material, direct labor. Direct labor is in 2 places. The second direct labor is not direct labor, it's a typo error. Supposed to be direct expenses. You can call it direct expenses or variable overhead. All right? So it's direct expenses. So we now less that, less your production cost, your variable cost from the sales, then you are going to have contribution. So this page will be, I don't want to go too far. Okay, let's say this is the first page for the first requirements, the second requirements, and then the third requirements. Worst case, 3 pages should be enough. Then our workings will start from here. Working number 1, I want to determine contribution margin. Okay. So there are 2 products, product A, product B, right? Then, this is too long. Let me reduce it. So to get the contribution, you are supposed to less, you less variable cost from the sales value. So sales, what's the sales of product A? From the table given to us, sales of A is 8.4 million. Sales of B is 25,200. 8,425,200. Okay. Then let me do total. Let me introduce a column for total, just in case. When you add the 2 together, that will give us 33,600. 33,600. Figures are in thousands. Then the less variable cost. To get the variable cost, we are given direct material. Direct material of product A is 2240, then 5040. 2240, 5040. This will give us 7,280. Then after direct material, we have direct labor 1120, 3360. 1120, 3360. This is direct labor. Okay. Then the total is 4480. Then after direct labor, I said that the other direct labor is not direct labor, it's supposed to be direct expenses. So please, Joseph, mute. Joseph, mute. Okay. So the other one is direct expenses. For A, direct expenses is 1,120,000. For B, 2,240,000. 2,240,000. When you add it up, that will give us 33. What's wrong with you? 3360. So that's all. That's all. We have considered all the variable costs. In fact, to get this contribution margin, there are three different ways. Based on the information given to us in the question, there are three ways I can calculate it. But without stressing ourselves, let's just move on with this. So here will be contribution. Contribution for product A. Bring out your calculator. 8,400 minus 2,240 minus 2,440, 2,240. That's 3,920. Here is 3,920. Then for B, 25,200 minus 50,40 minus 5,600. Okay, 14,560. So 14,560 plus 3,920, 18,480. So the total contribution margin is 18,480. So to now get the contribution margin ratio, I will then go back here. The overall contribution margin ratio. Total contribution for the company as a whole is 18,480 divided by total sales. Total sale is 33,600. Okay. Divided by 33,600. We have 55%. 0.55 is the contribution margin ratio. Now that we have the contribution margin ratio, step 2 is to calculate the overall break-even point in Naira. So, break-even point in Naira. This will be the break-even point for the company as a whole. So break-even point in Naira is computed as fixed cost divided by contribution margin ratio. According to the question, how much is the fixed cost? We have two types of fixed costs. We have fixed overhead. The total fixed overhead is 2240. We also have fixed selling and admin expenses, 8320. So that will give us the total fixed cost. So let's go and compute that. Working number 2, fixed cost. Okay, we have fixed overhead to be equal to 2240. We also have fixed selling and admin to be 8. Is it 8320? Let me confirm. Yeah, 8320. So when you add the two together, that will give us 10,560. 10,560,000 is our fixed cost. So let's go up there. Fixed cost, 10,560,000. You write it out in full so that you don't make mistake. Our contribution margin ratio is 0.55. Therefore, break-even point in Naira is equal to 10,560 divided by 0.55. 10,560, 10,560 divided by 0.55. 19,200,000. Okay, so that's our break-even point in Naira. Step 3 says you should calculate sales mix. You are asked to calculate sales mix. To get the sales mix, you are supposed to divide the sales value of each product with the total sales value. So sales mix for product A, product B. The sales of product A is 8,400. The total sales is 3,360, 3,600. Therefore, 8,400 over 3,600. We have 0.25. 25% is the sales mix of product A. For product B, we made sales of 25,200,000 divided by total sales of 3,600. Okay, so 25,200 over 3,600. We have 0.75. So sales mix of product B is 75%. All right. Then step 4, you are supposed to calculate overall break-even points. You are supposed to calculate break-even points in Naira for each product by dividing or by multiplying the sales mix with the overall break-even point in Naira. All right. And then step 5, you calculate break-even points in units for each product. by dividing the break-even point in Naira of each product with the selling price. Okay, so let's use it. We are going to merge step 4 and 5 together in a table. So here we want to determine, let me move to the second page so that I don't manage space. Step 4 and 5. So we want to calculate break-even point in Naira and units for each product. So create a column for products. Sales means we have break-even points in Naira. We create a column for selling price. Then the last column will be break-even points in units. We have two products, A and B. Our sales mix is 0.25 for A, 0.75 for B. Okay. Let me complete the table. All right. So selling price of product A is 120. Selling price of product B is 180 Naira. Here, the total sales mix is 1. We want to share to get the break-even point in Naira for each product. You are supposed to multiply the sales mix of step 3 with the break-even point in Naira in step 2. So break-even point in Naira in step 2 is 19,200,000. Therefore, 0.25. Okay, I have 0.75 on my calculator. So 0.75 multiplied by 19,200. That's 14,400,000. So to now get the break-even point in units, you are supposed to divide 14,400,000 by selling price. So divided by 180 equal 80,000 units. Then for product A, 0.25 multiplied by 19,200,000. We got 4,800,000. Then to get the break-even point in units, you divide that by the selling price. 4,800,000 divided by 120 Naira. We got 40,000 units. Okay? 6 marks. We are done. 6 marks, you pocket it. You are looking for 94 marks or 94%. Okay? So that's that. Let's move to the B part of the question. Before we move, let me know if you have any concern on the way we solve the question so that I can provide any clarification. So number B, requirement number B, examiner is asking you that you should calculate how much sales revenue must be made to earn an after-tax rate of return of 12% of the revenue. Examiner is asking you to calculate sales revenue that must be achieved to earn a rate of return of 12% after tax on that revenue. The revenue, you don't know it. You don't know the revenue, and you want to earn a rate of return of 12% on something that you don't know. All right, how do you do this? Quickly, let's look at it together. Okay. Calculating sales revenue to earn an after tax to earn an after tax rate of return of 12% on revenue. That's what examiner wants us to do. So, how do you then calculate this? You don't know the sales revenue. You will recall when I was giving you the the formula to calculate break-even points in Naira to achieve a targeted profit after tax, or to achieve a targeted profit where profit after tax is given to you. That same formula is what you are going to use to calculate the sales revenue. All right. Therefore, since I don't know the sales revenue, I need to define my variables. I will then say before that, let's write out the formula. I want to determine sales revenue to earn an after tax of 12% rate of return. Therefore, this should be sales revenue equal to, now, again, like I said, let's define the variables first. I will say let's sales revenue, let me do it this way. Let sales revenue equal to X, because it's sales revenue that I want to determine. I don't know it. And our examiner asked me to determine 12% on the sales revenue that I don't know. I mean, to earn a rate of return of 12% on the revenue that I don't know. So since I don't know the sales revenue, let sales revenue equal to X. Therefore, I would then say, okay, let me do it this way so that it will be clearer before we make this assumption. Let's do it this way. Sales revenue would then be equal to fixed costs plus targeted profit after tax divided by 1 minus tax. Everything over, let me give a space, divided by contribution margin ratio. So you remember this formula. That's the formula we are going to use. Okay, because you want to earn a rate of return of 12% after tax. Therefore, we can then say let sales revenue equal to X. I don't know the sales revenue. Then my fixed cost. Fixed cost has changed. So we need to go and calculate fixed cost. Examiner told us in the question that additional 456,000 naira will be spent on advertising. That means fixed cost has increased. Therefore, I will then go back and do adjustment for my fixed cost. My revised fixed cost, number 3. Revised fixed cost. The existing fixed cost is 10,560,000. Current fixed cost equal to 10,560,000. Advertising equal to 456. 456,000. So when you add the two together, that will give us 10,560 plus 456, 10,560 plus 456. That's 11,016,000. Okay, that's the revised fixed cost. So revised fixed cost is 11,016,000. Let's write out everything in full. Then the targeted profits after tax, you want to earn a rate of return of 12% after tax. So targeted profits after tax equal to 12%. 12% of X. You know, it's 12% on the revenue. We don't know the revenue. Our revenue is X. Therefore, 12% of X is the same thing as 0.12X. Then 1 minus tax. We are told that tax rates 1 minus tax equal to 1 minus 0.40. Tax rate is 40%. So 1 minus tax will then give us 1 minus 0.4, which is 0.60. We are getting there. Then contribution margin ratio. Pay attention to what I'm about to say. In the question, ordinarily we are supposed to calculate contribution margin ratio. So because there are changes, the direct material has changed, direct labor has changed. So if that is the case, that means our contribution will also change. But in this particular instance, it's not just that contribution will change. Examiner has given us the proportion of revenue for product B to be 80%. When you look at the last line item additional information number 5 under B, you are told that 80% of the total revenue will be derived from product B. So anytime you are given a proportion of products under break-even, if examiner give you a proportion of products under break-even, that means you need to compute composite contribution margin. You need to compute composite contribution margin or composite contribution margin ratio. So since we are calculating contribution margin ratio, so it has to be composite contribution margin ratio. If you like, you can call it composite contribution margin ratio or weighted average contribution margin ratio, whichever one. However, before we can achieve this, we need to go and compute. We need to calculate a revised contribution margin. Once you get revised contribution margin, you then calculate revised contribution margin ratio for each product. Then you calculate the composite contribution margin ratio. But we cannot do that for now. You need to first of all make adjustment for your direct material and direct labor because the two of them have changed. We are told that direct material cost is expected to drop by 10% for product A and 20% for product B. Even before that, the first line item, the first additional information, examiner told you that unit selling price of product B is reduced to 160 naira. So we need to make adjustment first. Okay? So let me go back to my working. Working number 4. I want to calculate revised sales for product B. You know, sales is selling price multiplied by the units sold. Therefore, you need to first of all determine the units sold. What's the current unit sold for product B? Once you have the units sold, you now multiply with the this new selling price of 160 naira. So working number 4. First thing first, we need to determine the units. Units sold for each product. For product A, total sales of product A, you know, units sold is sales divided by, let me do it this way. Units sold equal to total sales divided by selling price. So for product A, the total sales of product A is 8,400,000 divided by selling price. The current selling price of product A is 120 naira. Therefore, 8.4 million divided by 120 naira. That's 70,000 units. Then for product B, total sale is 25,200,000 divided by 180 naira. 25,200,000 divided by 180. We have 140,000 units. Okay, so now that you have the units sold for each product, then you need to calculate the revised sales for product B. Product A is not changing. The sales of product A will still remain 8.4 million because examiner did not tell us that it will change. So working number 5. Revised sales of product B. Okay. To get the revised sales of product B, you are supposed to multiply the units sold of 140,000 with the revised selling price of 160 naira, because the selling price of product product B has reduced to 160 naira. Therefore, 140,000 multiplied by 160, we have 22,400,000. So the sales of product B has reduced from 25,200,000 to 22,400,000 because the selling price has reduced to 160 from 180. Okay, that's that. Now, again, working number 6, we need to determine the revised direct material cost. Revised direct material. Okay. For each product, we are told that direct material will reduce by 10% for A and 20% for B. So direct material for product A will reduce by 10%. The current direct material of product A, what do we have there? Direct material of product A is 2240. So I would then say 2240. We are told that it will reduce by 10%. That means we are supposed to account for 90%. Multiply by 90%. Okay? If you like, you can say 100 minus 10%. You are still saying the same thing. So 2240 multiplied by 0.9 equal to 2016. Then for product B, direct material of product B, according to the question, is 5040. So 50, 40, 5040 multiplied by 80%. We are told that direct material of B will reduce by 20%. 100% minus 20% will give you 80%. Therefore, 5040 multiplied by 0.8, that's 4032. When you add it up, that will give you 6048. Then, working number 7, direct labor cost. We need to calculate revised direct labor. Okay, so according to the question, we are told that direct labor cost will increase by 10%. So 10% for each product. For product A, the current direct labor cost for product A is 1120, 1120, 1120. It will increase by 10%. 10% plus 100% will give us 110%. 110% divided by 100 will give us 1.1. Therefore, 1120 multiplied by 1.10. Okay? 1120 multiplied by 1.1. 1232. For product B, direct labor cost of B is 3360. 3360 multiplied by 110%, which is 1.10. So 3360 multiplied by 1.1. 3696. When you add it up, here will be 4928. That's the total. What else? What other adjustment do we need to make? I think that's all. We have done working. Yes, the next one will then be our contribution margin. All right. We need to calculate contribution margin. After that, we then calculate contribution margin ratio, which is composite. And then we calculate composite contribution margin ratio. Working number 8. Since our direct material, direct labor have changed, not only that, the sales of product B also changed. That means we need to calculate a revised contribution margin. All right, so I will then say contribution margin to make life easy, so that we are not just doing different step-by-step kind of working. So let's just do the final one, which is contribution margin ratio. To get the composite contribution margin ratio, we need to first of all calculate the revised contribution margin for each product. Once we get the contribution margin for each product, we then calculate the composite, we calculate contribution margin ratio of each product. After that, then we calculate composite contribution margin. Let me just break it down. Let's do it this way. Contribution margin or revised contribution margin ratio. For each product. So this has nothing to do with the company as a whole. We are not calculating overall. This is for just for each product. So we have product A, we also have for product B. Sales of product A still remain 8,400,000. Sales of product B has reduced to 22,400. Working number 5. Here is 22. 400, working 5. Okay, then we less variable cost. Direct material. Direct material. Revised direct material for A is 2016, B 4032. 2016, 4032. This is working number 6. Then direct labor, revised direct labor, 1232. 1232. Then for B, 3696. Working number 7. Then, of course, direct expenses still remain the same. Direct expenses, examiner did not give us any information on that. That means there's no change on direct expenses. 1120, 2240. Let me confirm that 2240. Direct expense, yes, 2240. Okay, so then we don't get the contribution margin for each product. 8400 minus 2016 minus 2352, 2352, 4032. Contribution margin is 4032.
4032.
Okay. Then for B, this will be 2240, 22400 minus 4032 minus 5936. 5936 equal 12432. 12432. So this represents contribution margin. So now that you have the contribution margin, let's say this is A. Our sales is A, contribution margin is B. So we need to calculate contribution margin ratio. Therefore, contribution margin ratio will then be equal to B over A. That is contribution divided by sales. So I have 1432 on my calculator divided by 22400. That's 0.555. 0.555. Then for A, 4032 over 8400. 0.48. So that's the contribution margin for A and B. Now that you have the contribution margin, you can then go ahead to calculate composite contribution margin ratio. I repeat, the reason why we are calculating composite contribution margin ratio is because in the question, examiner has given us proportion of each product. In the last additional information number 5, you are told that 80% of the total revenue is attributable to product B. So if 80% is for product B, it means 20% is for product A. All right. So if that is the case, we need to calculate composite contribution margin ratio. Like I said, you can either call it composite contribution margin ratio or weighted average contribution margin ratio. You only calculate composite contribution margin ratio or composite contribution margin if in the question you are given the proportion of each product. So composites contribution margin ratio. Let me shorten it. Contribution margin ratio. How do you calculate composite contribution margin ratio? The composite contribution margin ratio is computed as the contribution margin ratio of each product multiplied by the weight or proportion of each product. Okay, so contribution margin ratio of product A multiplied by the weighted average of product A on one side plus contribution margin ratio of product B multiplied by the weighted average or the proportion of product B. Okay, so that's the formula. Where, let me define it for you. Where WA equal to the proportion of each proportion of product A, proportion of products A, WB, proportion of product B. All right. So the composite contribution margin ratio will then be equal to, for product A, contribution margin ratio of product A is 0.48, 0.48, multiplied by, in the question, 80% is attributable to product B. It means 20% is for product A. Therefore, multiply by 0.20. Let's say this one is equal to 20%. Let me do it this way so that it will be clearer to you. 0.20. This one is 80%. 0.80. All right. Plus 0.555. Contribution margin ratio of product B is 0.555. Let me rewrite it. What's wrong with you? 5. 5. 5, 5, 5. Multiply by 0.80. So composite contribution margin ratio would then be equal to 0.48 multiplied by 0.2, 0.096 plus 0.355 multiplied by 0.8, 0.344. Therefore, composite contribution margin ratio would then be equal to 0.344 plus 0.096
0.5.
0.54
4.
or 54%. So composite contribution margin ratio is 54%. So if that is the case, we then go back to our formula. You have to shine your eye. You don't rush any question without understanding it. Okay, so here is composite contribution margin ratio. So I would then say composite contribution margin ratio equal to 0.54. This is working number 9. All right. This one is working number, our fixed cost. The revised fixed cost is working number 6, I think. No. Working number 3. Okay, so that's that. Now that we have all the variables available, we can then proceed to get our sales revenue. So our sales revenue still remain as X. That's what we want to calculate for. Our revised fixed cost is 11,016,000 plus targeted profit after tax of 0.12, rate of return of 0.12 of X divided by 1 minus tax, 60%, divided by composite contribution margin ratio of 0.54. So X will then be equal to 11,016,000 plus 0.12 divided by 0.6, 0.12 divided by 0.6, that's 0.20, 0.20x, then divided by 0.54. So in this, what do? We cross multiply. So this will be 0.54x equal to 11,016,000 plus 0.20x. Next, we need to collect like terms. Therefore, 0.54x minus this 0.2x will come to the left, minus 0.20x equal to 11,016,000. 0.34x equal to 11,000. Therefore, x equal to 11,016 divided by 0.34. Therefore, x equal to 11,016.
32,400,000.
32,400,000. Okay. 32.4 million. 32,400,000 is the sales revenue to achieve an after-tax rate of return of 12%. So that's that. I would then say the sales revenue, this requirement is supposed to be more than 5 marks because it requires more thinking relative to the A parts. The sales revenue to earn an after-tax rate of return of 12% on sales revenue is 32,400,000. 5 marks, you pocket it, plus 6, 11 marks. We are getting there. The last one, number C, requirements. You have to assume all the facts in B1 to 5 above, but the original budgeted revenue of 33,600,000. Compute the revised break-even sales in unit. What examiner is simply telling you is that based on these changes, calculate contribution, calculate break-even points in units. Okay, so number C, calculating revised break-even points in units. Okay, so how do you do this? Just follow the same procedure. Step 1, you have to calculate the overall contribution margin ratio. In this case, it will be our composite contribution margin ratio, which is the same thing as 0.54. Okay, then step 2 says you should calculate the break-even point for the company as a whole, break-even point in Naira. So break-even point in Naira. So the break-even point in Naira will be the revised fixed cost. The revised fixed cost is 11,016,000. Okay, divided by the revised contribution margin ratio of 0.54. Okay, so 11,016,000 divided by 0.54. That's 20,400,000. Okay, then step 3 says you should calculate sales mix. So examiner has already given you the sales mix. A, sales mix of product A is 20%, 0.20. Sales mix of product B is 80%, 0.80. And finally, you calculate, let me manage this space. You calculate break-even points in Naira and then in units. Let me manage it. Step 4. Let me do it this way. Step 4 and 5. So break-even points in Naira and units for each product. So we have products, sales mix, break-even points in Naira, selling price, then break-even points in units. Product A, product B. All right. So selling price of product A still remain 120. Selling price of product B has reduced to 160. The sales mix is 0.20, 0.80. Then we want to share the break-even point, the overall break-even point in Naira, which is 20,400,000. So 20,400,000. Therefore, 20,400,000 multiplied by 0.2 equal 4,080,000. To get break-even point in units for product A, 4,080,000 divided by 120, 34,000 units. Then 20,400,000 multiplied by 0.8, 16,320,000 divided by 160, selling price, 102,000, 102,000. That's it. 15 marks. You pocket it. You are looking for 85 marks. Okay? So that's that. That's end of the question. Let me know if you have any question for me before we move to solving another illustration on this. Any question? If there is none, then let's have one more illustration. Okay, let's solve illustration number 6. Ogadimma. Let me stop sharing. Yes, I need one of you to read for me. Who is helping us to read? Angela Olua, can you help?
Yes, sir.
Go ahead.
Okay. Ogadima Limited retails two products, common and executive traveling bags. The budgeted income statement for year 2015 is as follows. We have the requirements. Okay. Requirement A, calculate the break-even units, assuming that the planned revenue mix is maintained. B, determine the break-even point in units if only common bags are sold and if only the executive bags are sold. Requirement C, calculate the budgeted operating profit and break-even point if 200,000 units are sold, but only 20,000 are executive bags.
All right, thank you very much, Angela. Yes, that is the question. You have to calculate the break-even units, assuming that the planned revenue mix is maintained. That is, the revenue as you have it for common and executive, 60 million, 30 million, they still remain the same. So without wasting time on this, you want to calculate break-even points in units. And you know that this company, Ogadima Limited, produces common and executive bags. That means Ogadima is a multi-product company. Therefore, to solve the A requirements, you are supposed to carry out the 5 procedures. I'll stop sharing this and move to the working notes straight. All right. Solution. So illustration 6, still on page 54. All right. The name of the company is Ogadima Limited. So number A requirements, we are to calculate break-even point in units. All right. Like I said, since Ogadima is a multi-product organization, so we are going to follow the 5 procedures. Step 1 is to calculate the overall contribution margin ratio, which is contribution, the total contribution for the company as a whole divided by total sales. So according to the question, the total contribution given in the question is 30 million naira. Total revenue is 90 million. Therefore, 30 million divided by 90 million. This will give us 0. That will give us 1/3, which is the same thing as 0.33. Now, pay attention to what I'm about to say. Please, under break even, when you are calculating contribution margin ratio, especially if it is not the final answer, you have to ensure that you write out your your figures in full. Don't round it, because if you round it, you are not going to arrive at the correct answer. So in this case, when you divide 30 divided by 90, you are going to have 0.33333 in 9 places. So you have to write out everything. So I will come here 0.33, 4, 5, 6, 7, 8, 9. So that's what you are going to do. Because if you do 0.33, you cannot get the right answer. Then step 2. Step 2 says you should calculate break-even point in Naira for the company. So break-even point in Naira, which is equal to fixed cost divided by contribution margin ratio. According to the question, fixed cost is 12 million Naira. Here is 12 million, then divided by 0.33, 4, 5, 6, 7, 8, 9. So from your calculator, 12 million divided by 0.33, 5, 6, 7, 8, 9. That will give us 36 million Naira. So the break-even point in Naira for the company as a whole is 36 million Naira. So let's say, for example, now, this is what I was telling you the other time. Let's say, for example, you have rounded your number to 0.33. Let's see what we are going to get. 12 million divided by 0.33. So this one is giving us 36,363,633. So you can see. So there's no way you can get the correct answer if you round your number. And that's why, to minimize your rounding, to minimize your, just write out whatever you have in your calculator, everything in full. Okay? So that's that. Then step 3.
Sir, but after this, sorry, sir. I said there is still 0.4 after this 36. Should we still continue writing it like that?
3.4. 3.4 is not up to, no, you can't round down one. It's not up
No,
to.
I mean 0.4. No.
You
This
have to ignore
36
that
million that
one.
we got, there is. Oh, okay.
So step number 3, you calculate sales mix. Let me move to the next page. Step 3, sales mix. For product A, comma, sales mix of common. To get the sales mix, you are supposed to divide the revenue of each product with the total revenue. Revenue of product A of common is 60 million divided by total revenue of 90 million. So this will give us 0.6666 5, 6, 7, 8, then 7. Okay. Then for executive bag, 30 million revenue divided by total revenue of 90 million. This will give us 0.33%. 5, 6, 7, 8, 9. So by the time you add the two together, it must be equal to 1. Okay. Then step 4. You have to calculate step 4 and 5. We married step 4 and 5 together, which is to calculate break-even points in Naira and units for each product. Okay, so we have products, common, executive. All right, then sales means 0.66645678. Then 7. 1, 2, 3, 4, 5, 6, 7, 8, 9. Okay, this will then be equal to 1. All right. After 6 means break-even point in Naira, then selling price, break-even point in units. All right. So the selling price of products of common is 200 Naira. Selling price of executive is 300. We want to share 36 million Naira between common and executive. Therefore, 36 million Naira multiplied by 0.66, 5, 6, 7, 8, then 7. So this will give us 24 million. $24 million divided by 200 Naira. That's 120,000 units. Then for executive, 36 million multiplied by 0.33, 5, 6, 7, 8, 9. That's 12 million. Divided by 300. That's 40,000 units. Okay, so that's that, 3 marks. Within 2 minutes, you are done with this calculation. Then you move on to the next one. Number B. Requirement number B. Examiner is asking you to determine the break-even point in units if only common bags are sold and if only executive bags are sold. What the examiner is simply saying here is that you have to assume that the company produces only one product, only common. If it is only common, then what's the break-even point in unit? If it is only executive bags, what's the break-even point in units? That's what you are asked to do. Therefore, B, Roman figure 1. So break-even point in units if only common bags are sold. So in this case, break-even point in units will be calculated as fixed cost divided by contribution per unit. Okay, which is equal to, fixed cost in the question is 12 million Naira. Contribution per unit for common, selling price of common is 200 Naira. Variable cost of common is 140 Naira. Therefore, let me rewrite this. 200 minus 140. Okay, so this will give us 60 naira. So 12 million divided by 60 naira. Divided by 60. That's 200,000 units.
200,000.
Yeah. Okay. So that's for comma. Then high. Break-even points in units. If only executive bag are sold. Okay. So we are to assume the company produces only executive bags. So in this case, break-even point in units will be equal to fixed cost of 12 million naira over contribution per unit of executive. That is 300 naira minus 180 naira variable cost. That will give us 120 naira. So 120 naira, 12 million divided by 120 should give us 100,000. 12 million divided by 120 naira. That's 100,000 units. That's it. You move on. Out of 15 marks, you are earned 9 marks. Okay? Then number C, you have to calculate the budgeted operating profits and break-even points if 200,000 units are sold, but only 20,000 are executive bags. So out of 200,000 units, if 20% is for executive, it means that 180,000 units is for executive bags. Sorry, it's for common bags. All right, so I will then come here. Number C. Before we calculate the break-even, we need to first of all calculate revised income statements. Okay, we need to calculate revised income statement. And that's what the examiner is saying you should calculate budgeted operating profits. Okay. Budgeted, this should be C1. Let's call this one C, Roman figure 1. Okay. Budgeted operating profit. Okay. So we have common, executive, then total for the company as a whole. 20,000 is for common. Out of 200, then the balance of 180 is for common. 20,000 is for executive. 180 is for common. So sales, selling price of common is 200. Executive is 300. Therefore, 180,000 multiplied by 200, 36 million. Then 300 naira multiplied by 20,000 will give us 6 million. 6 million plus 36 million will give us 42 million. That's the total sales, overall sales. Then variable cost. Variable cost for common is 140. Variable cost for executive, 180. Therefore, 180,000 multiplied by 140. That's 25,200,000. Okay, so 25,200,000 minus 36 million. 10,800,000 is the contribution for common. Contribution. Then for executive, 180 multiplied by 20,000. 3,600,000. 3,600,000 minus 6,000 minus 6 million. You give us 2,400,000. When you add the two together, all right, this should be 28,800,000 minus 42 million. It will give us 13,200,000. That's the total overall contribution. Then you less fixed cost. Fixed cost for the company as a whole is 12 million naira. You are not expected to apportion it, just less. Then our profits, the revised profit is 1.2 million. That's it. Okay, this is profits. Now, the second part of requirement number C, you have to calculate break-even points in units. Break-even points in units. You then carry out the 5 procedure again. Under this, the first step is to calculate the overall contribution margin ratio. Our total contribution margin has changed to 13,200,000. So here will be 13,200,000 divided by total sales of 42 million. Okay. 13,200 divided by 42 million. That's 0.3142. 857143. 857141234124. 1234. Okay, let's just say 43. All right. Then step 2, you calculate break-even points in naira for the company. Break-even points in naira, which is fixed cost of 12 million naira divided by contribution margin ratio 0.3142857143. Okay, so 12 million divided by 0.3142 857143. We have 38 million naira, 181,818 naira. This represents the overall break-even points in naira. So now that we have the break-even point in naira, we move to step 3, which is to calculate sales mix. Sales mix for common will be equal to the sales value of common. Sales value of common is 36 million over the total sales, 42 million. So 36 divided by 42, we have 0.8571. 0.85, let me write it. 85. Let me go to the next one. 0. What's wrong with you? 8571 8571 4285
571.
428571. 1, 2, 3, 4. Okay, thanks. Then executive equal to 6 million over 42 million. This will give us 0.14. Let me see.
28571.
14 what?
28571.
28571.
429.
429. Okay. So by the time you add the two together, it must give you 1. Must be equal to 1. Okay. So now that we have the sales mix, we can then go to the last part. Step 4 and 5 merge together. We want to calculate break-even points in naira and units for each product. Products, sales mix, break-even points, selling price, then break-even points in units. Okay, common, executive, sales mix, all right. Selling price is 200, then 300. We want to share 38 million 181,818 naira. Then the sales mix 0.85 7142. Then 8571. 8571. Let me give a space. Okay, then 0.14 2857 2857 1429. Okay, so we want to share 38,181,000. Therefore, 38,181,818 multiplied by 0.8571 4285 428571 equal 32,727. Here is 32,727, and then 273. 273. Whatever you have in your calculator, divide by 200 naira. So we have 163,636. 163,636 units. Then executive 38,181,818 multiplied by 0.1428 571 571429 5454 5,454,545. Okay. Last three. Yes, 545. 545. So whatever you have in your calculator divided by selling price 300. That's 18,182. 182. That's it. You can see from day one to date, break-even point and break-even analysis is not difficult. Just understand the techniques and you are good to go. Let me know if you have any question for me. This is where we are going to call it a day. Let me know if you have any question for me. So try as much as possible. Go and practice as many questions as possible as far as break-even is concerned. All right? Try and practice. Go and practice as many questions as you can lay your hand on. Okay? The more scenario that you test, the better for you. All right? Because you need to boost your confidence. And for you to be able to have the confidence, you need to experiment. You need to solve as many questions as possible. Confidence is a function of experience. When you practice as many questions as possible, you will gain the experience. When you are going to the exam hall on that day, your confidence will be very high. Okay? So, again, go ahead, pick the Pathfinder question and answers. Go and search for break-even analysis, break-even questions. So begin to solve all of them. If you have the golden book, I have about 9 or 10 question and answers, different scenarios in the performance management golden book. So you can ensure you go through all of them if you have it. If you don't have it, just go to Pathfinder question and answers. Go to ICAN website, download the past questions there and search for break-even. Okay? So that will be the end of today's class. We have risk and uncertainty and then learning curve theory outstanding to cover for this diet. Okay? I believe majority of you are doing financial management, and under financial management, we have started risk and uncertainty. The only thing that the scope of FM does not cover is the decision making under uncertainty, and that's what we are going to do under the performance management. We are going to do the decision making under uncertainty, where you have maximax, maximi, minimax, Laplace, Bayes. So that's what we are going to do in our next class. Once we are done with that on that day, that means we have only one period for learning curve theory. So thereafter, the only thing that you need is for you to be practicing. Go back to the videos and be watching them. Okay, so that will be the end of today's class. Finally, let me know if you have any question for me so that I can release you. Okay, so in the absence of no further question, I want to say thank you to every one of you for joining the class. I will see you next week by the grace of God. Good night, everyone.
Good night, sir.
Thank you,
very
sir.
much.
Good night.
Good night.
Yes.